Liquidity and inducement. What is inducement? These are situations where you find that market participants manipulate the market to create a false perception of the market direction. So basically it means a trap whereby you get into the market and the direction where you have predicted the market to be heading happens not to be the same direction. Then liquidity basically means orders or money. So liquidity is measured by volume of active or pending orders in the market, and I'm going to show you the different types of liquidity and also explaining areas of inducement. So when you get trapped into the market comes and grabs the orders where you have pressed and then goes to the direction where you had predicted. The first one, we have trendline liquidity. There are people who trade the trend line as a concept on its own, but for us, the smart money concept traders, we see it as trendline liquidity, whereby the market on an uptrend, the moment the market comes to a trend line, then buyers get into the market. But at the end, you find that the market will just create a false perception, take out the liquidity of the buyers at this point, then head to the same direction. The same to the sellers. You find that any time the market comes to the trend line, the sellers get into the market selling at those points. Then at the end, you find that it will give you a false signal whereby you will take a sell trade, take out the grab liquidity above that level, then continue selling. Then we have internal liquidity. So most of the times you find that on an uptrend, the market will usually form certain movement, an impulse, then it moves. In between here, it will create an inducement zone. So you find that early buyers will get into the market at this point instead of waiting for the true zone, which is the demand zone at the end, or a point of interest. May it be an order block, a demand zone. So the early buyers get into the inducement, and most of the times you find that at this area you are going to find that you have a fair value gap which has been filled, and the early buyers will get into the market because of this fair value gap, aiming to go higher. Then the market comes, takes out their orders at this point, then continues with the same direction. The same happens when you have a sell market, whereby you find that the market has a supply zone, then in between there is a inducement zone. May it be it can be a supply zone or a fair value gap in between. The market comes, takes out liquidity above that level, then continues to sell. Then we have equal highs and equal lows. When the market is consolidating, it might form equal highs and equal lows. So the market will take out the equal highs, sweep the liquidity above that level and also below that level, then the move happens. Then we have external liquidity. When the market is moving either the uptrend or downtrend, these levels here, this is external liquidity. But you have to know that when you have an uptrend, the market grabs liquidity above the higher highs. When you have a downtrend, the market will grab liquidity above the lower lows. Then we have the buy side liquidity and the sell side liquidity. You find that you have a point of interest. Then before the market comes into this point of interest, it moves downward. So expect the market to come and take out the sell side liquidity at the buy side liquidity. Sorry, I confused at this point. The buy side liquidity at that point, then continue moving downwards. Then when it comes to the sell side liquidity, so this is a sell side liquidity, the market will come, take out the sell side liquidity and continue moving up.